do like to start off every week, and it's been a couple weeks since we've done this show. I'd like to start off every week with, kind of what's happening in the stock market overall. And so if we look at, the chart that we kind of study on a regular basis here, um, we've had pretty substantial run, right? From that big drop that happened, really right after Liberation Day, which was the 2nd of April, where the shocking high tariffs, at least shocking to the market, happened. And then we had a pause and the market had a huge recovery. And that recovery has continued even though tariffs have kind of go up. And we'll take a look at that and kind of what's happened here as far as that goes. But it continues to run, right? And so it's kind of, I get a lot of questions from clients is like, why, if all these things are happening, is the market continuing to run? And because if you look at it, we're actually seeing, the gross domestic product has slowed down, right? We were at 2.3% last year. The first half of this year, we're at 1.2%. So economy's slowing, the job growth. This was a big deal. We didn't do the show that Friday, but that a couple Fridays ago, we got the job number, came out at 73,000. What was more important was they readjusted the previous 2 months quite dramatically. So, like, 144,000 jobs was knocked down to roughly 14,000. I'm kinda making this up, but that's it was a huge drop, like a 90% cut for the jobs that were reported in the previous 2 months, and so, the market dropped, quite a bit, more than 1.5% that Friday, but the dip buyers are still there. The people that believe this market is gonna continue to do well are still there, and so it's kind of this continued battle, a teeter-totter battle. And I think what's happening is that a lot of, if you look at the interviews and look at what's going on, a lot of the big money actors, the hedge fund managers and what have you, that are more kind of that more traditional money management style, are looking at the tariffs and the possibility for inflation there and saying, hey, let's back out here. Let's just hold, we have a third out for the same purpose, right? And so and what's left is these people that believe, first of all, the tariffs won't have an impact because maybe Trump will, reverse course. They love the artificial intelligence, which is going to make up for everything. Even though things might slow down overall, maybe it gets picked up because artificial intelligence is creating higher productivity, right? All of these different types of things. And then you do have all these kind of quant funds in there now. There's a lot of computerized trading programs that are in the market that they don't care which way the market's going.
Yeah, they just trade on the price movement.
Right, and so price movements up, they're buying and buying and buying, price moves down, they're shorting, 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 so when you take out one chunk and they're all sitting on the sidelines, what you have left is the people that believe this thing's gonna go, right? And we'll talk about, why it could go, and we'll talk about why it might not go, as far as that goes, because I think that's important coming forward, but at the moment, the market, I think it's really healthy. I mean, every single time we have a little bit of a dip, but from a pure price standpoint and momentum standpoint, price action standpoint, it's a good market. I mean, it really is a good market, and honestly, if it wasn't for tariffs and some of the things that I see that are possible, problems coming up and I didn't know about those, and I was just looking at price, we'd be in, just like last year and the year before, because again, price action does matter. So let's go through some of the things that happened. So first of all, just quickly, the consumer price index came out this week, and it was at 2.7%. So it was year over year. All right. And if you look at that, it's a 3-year chart, pretty anemic, really,
Yep.
for quite a while, right? I mean, up a little bit here, but nothing. It was actually expected to be at 2.9%. And again, this is top line, all included food and energy inflation.
Yeah, gas really held it down.
Yeah. Gas was down 9% year over year. And so, yes, exactly right. And so some of the pieces brought it down. But even on a core basis, with taking out food and energy, the CPI was still pretty reasonable. Didn't seem like any effects really from the tariff. Now, like we did last time this came out, we dug into some of the categories that are tariff related, and they're going up quite a bit,
Yeah.
right? Okay, they're just not a big enough tariff category to offset some of these other areas that are kind of coming back.
A lot of those are kind of one-time expenses, a lot of
Yes.
these goods that are people tariff expenses, and so a lot of people just are not buying them.
Yeah, yeah, exactly right. That's kind of interesting. So that's where you get into kind of a slowing economy, and we'll talk about some of that too here. Okay, so we presented this 2 weeks ago on the show, and so this is just kind of what are the precursors for seeing the CPI or the PCE, the two kind of consumer price indexes that would show increasing inflation. What are the things that move first before that? So again, this is hard to see, but that orange line, okay, that is the ISM Manufacturing Prices Paid Index. So when that orange line's going up, like you can see at the very beginning of the chart, the manufacturers are paying more.
Mhm.
Yeah. And then you look at the purple line, which is the CPI, that's what consumers are paying. And so you can see the lag. When that orange line goes up first, eventually that purple line catches up. And just the opposite. Notice that the orange line came down before the purple line came down, right? And so now if you look right over our heads, you can see that big spike,
Mhm.
right? It is way up, and the purple line hasn't moved yet. All right. So today or yesterday, we got another precursor for, possible future inflation increases into the consumer, right?
Mhm.
And that was the producer price index. So again, this is going back, for a 3-year period, and you can kind of see it was trending down more or less for the year, and then jumped up quite a bit. And this chart's a little bit hard to understand, but this is how much it moved month over month.
Yeah, it was a really big spike.
That was a huge spike. Actually, matter of fact, it's the biggest we've had going back for 3 years. So what happened was, so that if you look at like June of this year versus July of this year, which is month over month, it jumped by 0.9%. Um, and interestingly enough, goods went up by 0.7%, services went up by 1.1. So that's the second time I've seen services gaining more. And they're not affected by tariffs directly,
Mhm.
right? But they're being affected by probably increasing wages and different things along those lines. And actually, when you break into services, one of the biggest things you see is insurance, whether it's auto insurance or fire insurance. Both are being affected by these big calamities because when there's a huge hurricane flood, a lot of autos get damaged as
Yeah.
well as homes and
Especially
infrastructure.
as their prices increase too, it just
Right.
becomes more costly to insure.
Yeah, I think I forgot what the numbers were, but they've determined that they're being allowed to increase here in California our homeowners insurance by was it 20 something percent, was because they have to go through the commission to be able to, they have
Get
some caps,
approved,
and
yeah.
it was quite high because of the Palisades fires and the different things that have happened. So anyway, so this is a precursor. So if we look at, okay, manufacturers start to pay more, right? Now wholesale prices start to gain, and then eventually you'll start to see gains in that CPI. So the prices are going up. There's no doubt about that. The foreigners are not paying the tariffs. American importers, American companies, and eventually American consumers are going to pay these tariffs. Okay, that's for sure. I can hang my hat on that. However, we're not seeing it, fully in the numbers to see what that split is, because it does matter. If it all goes through to consumers, they'll start to be able to pull back, and that's when you start to see things slowing down. If on the other hand, the other extreme, it all stayed with companies and they just ate it, you're going to see less hiring, more layoffs, and slower growth
You
because
would see
they're.
the market react very negatively to that.
Yes, exactly. So maybe even more so by companies keeping the tariff money in house and not passing it on than you might if the consumers were paying. You might see more market reaction to that, right? So this is the tariff picture. This is from the Yale Budget Lab, which if you get a chance and you're curious about how this is all working, they have a really good website. They update it very consistently each time tariffs change. So we're up to an 18.6 effective average tariff, with you can see that bump there was like 50% to India. We went from, I think, 25% to 50% on India. Might not stay there, because
Mhm.
it's sort of a negotiating tactic. But you can see it was way higher for a while, right after Liberation Day, mainly because China was at 145% for a bit. And then once they kind of dealt with that, they started to come back down. So now, please note that at the beginning of this chart, the average effective tariff was about 2.5%, right? So we've come a long ways, and so that whole thing, that little, you know, bump in tariff costs is going to work its way through this entire economy, and then just long term, this is kind of fascinating. This is going back to the 1700s for what our average effective tariff rate was since 1790. And so we had much higher tariffs prior to 1900. than we have now, we had no federal income tax. And so the way that they would generate income to fund the government at that time was through tariffs and to protect some smaller industries and things along those lines. And the last big tariff we had was 1930, and you can kind of see we're close to that now as far as that goes. You can see we went straight up from
Yeah.
being quite low. And what happened there was, of course, unemployment was at 6%. They wanted to try to protect, American industries and drive unemployment down. But of course, it went the opposite direction, which is what's going to happen now. Also, unfortunately, it went from 6% to 25% unemployment. And stock market ended up dropping a total of 87% from its highest point to its lowest point. And so that's kind of created this scenario now through accords and what have you. You can see, decade after decade, the tariffs have been coming down. Free trade has become, and we're reversing that whole trend right now. I will say, if you look at that 1930 tariff, and for the most part, those things don't stay up like that. It probably won't stay up. So that could be a good thing. So that's, I think, partly what the market's relying on here is that tariffs at this level won't work. They will start to create problems, and Trump will make an adjustment to those tariffs to bring them back down. I still think there probably is some tariff rate above 2.5% that they could do, but it's probably not 18.6.
Mhm.
Matter of fact, it's probably in the single digits, but maybe high single digits. I don't know,
Yeah.
And so, and that would be okay, right? As long as you could do that before something fell apart. And that's one of the big problems that's happening right now. There are people like Jamie Dimon running around saying, hey, even a small recession could create a really big recession if things start to fall apart behind the scenes. And he's specifically talking about private credit, which has expanded dramatically. And so, these are loans that don't have regulations. And again, it's the same problem we had with the bad mortgage loans that
Yeah,
happened in 2008.
because it's private, there's
Yeah,
limited data, you
right.
just don't know what they're doing. It's
We don't know how much there is, just like during 2008. We didn't know how much credit default swaps there were, which are these insurance policies that sit on top of these mortgages. And apparently it was $7 trillion that was set up in 5 years because it was private, right?
Mhm.
And we don't know what level of loan it is in terms of the quality. I mean, are these junk loans, great loans? I mean, what's the overall issue? And so what happens is when loans start to default, these companies are trying to scramble around and cover those defaults, right? And whatever assets that they might have can often be sold. And that's what we saw in 2008. That's why diversification didn't work in 2008. Everything went down. Gold went down, IBM went down, Cisco went down, everything because these companies are having to sell to pay off these credit default swaps, right? Um, so that's always in the back of the mind here once you start pushing on something as hard as we're going to push on the economy here. And, the Yale Budget Lab has a projection for what they see happening to gross domestic product going forward. And you can see it starts to drop. Okay. That's a negative, at least up until the bottom of that is the second quarter of 2026. So almost a year from now,
Mhm.
right? So between now and then, we'll continue to see if tariffs stay at this level and don't get adjusted, right? Which is a big if. It will continue to see gross domestic product, according to them, continuing to erode. Okay. So again, that's what Jamie Dimon is talking about. That's that little bit of something that can turn into a bigger something. Okay. And so that's the line we're walking right now. Tariffs could be a nothing. They have been a nothing so far, especially for the stock
Mhm.
market. They could be a nothing all the way through if they're able to kind of pare them back down, or if by some miracle, even at these levels, things are so different in today's world and there's so many other compensating factors that they don't matter, right? That's possible. However, probability makes me feel like I want to be 1/3 of my stock market exposure, my normal exposure out, and 2/3 in, because that's the bet. Okay. 2/3 in because things could work out. There's a lot of positives happening. The big, beautiful budget bill is good for the stock market, those kind of things. So, all right. Now, here's the other reason to be 2/3 in or more, and that is because the Federal Reserve, as I think they're likely to make a rate cut in September. I would like to review that statement after the Jackson Hole speech, which happens on the 22nd of this month, and see what Powell says, because we're seeing both. We're seeing a decrease in the employment market, which is what they'd want to support. We're seeing the gross domestic product slow down, which is also what they'd want to support and by lowering rates. But we're also seeing prices going up. If you look at, the 0.9%
Mhm.
growth in wholesale prices that just happened yesterday, so they're going to be in the spot where, so this is the Fed watch tool. Currently, we're at 89%, bet by the market that by the 17th, I believe it is, of September, which is when the Fed will meet, they'll be reducing by one quarter of 1%. All right. That's vacillated a fair amount here as data comes in. There's still a bunch of data that needs to come in before this happens, right? We're going to get the PCE inflation report at the end of this month. We'll get another,
CPI,
another CPI. We'll get another. We
PPI.
might get another jobs report.
Mhm.
They fired the person producing the job report numbers, not person, the person ahead of all of that. There's a big group of people, but and one of his comments was to maybe do it quarterly. Seems to have shot that down even on his own, just because it's probably pretty important. I will say though, that it isn't partisan. I mean, the jobs report that we get, which is a big number that's really important, the market reacts to, gets revised pretty dramatically.
Mhm.
It's incredible. I don't pay as much attention to it as I used to because of that. So, nonetheless, there's a comment of don't fight the Fed, right? The Fed starts to reduce rates. Generally speaking, the stock market does well, but not always. Right? They started cut rates in 2007. The stock market dropped 57% from that point in time. So, sometimes when they're cutting rates, it's because they really need to, and things are falling apart. And in 2008, we had something behind the scenes. In this case, Lehman Brothers, falling apart and collapsing the whole. Really, the financial system really struggled in that period of time. So uh, that's where we're at this point in time. I think it's. I think it's pretty interesting. You can make a strong argument that this market's going to do well, that the deregulations, the lowering of interest rates, the big beautiful bill with the taxation reductions, the artificial intelligence excitement, money being spent there, power generation, all of these areas outdo all the other issues, which would be the possibility of higher prices caused by deportations and tariffs. Right? Those are those. That's the battle that we're kind of dealing with, and again, I'm on the side of believing that the market will do well to the point of being two-thirds in, but I am one-third out just because of, well, our clients, this is their life savings, right? The T-bills are paying well right now compared to where they were before. So that's not a terrible place to be for a bit here and see what happens. So anyway, we'll see how this plays out. I think, as we go week by week here, it'd be really interesting to see, what happens. I've been talking about the impacts of tariffs hitting in August, September, October, beginning of that, feel. We get some feel, and that's exactly what's happening. We just got that PPI report starting to show things yesterday. And so, again, it's working its way through, and we'll have to see what type of impact it does have as far as that goes. So, anyway, thank you for joining us for this summary for this week. Look forward to being able to do this again next week.